Hello, my name is Ajit Mohan. I am a master's student in Dr. Theodore Trefalis's investment analysis class, and I will be doing my final project on the capital asset pricing model and its relevant towards emerging markets returns. So, what is the capital asset pricing model? And it's one of the premier financial models that was created by two economists, William Sharpe and John Lintner, in 1964. And throughout the industry, it's widely used to calculate the cost of equity of a certain security. And essentially, what the basic premise behind the model is that investors require additional return for taking on additional risk. So it means that investors are risk averse. So that's one of the key principles that underlies the model as a whole. And the risk in the model is measured by a variable called beta, which is simply the covariance of the returns of that security with that of the broader market overall. And the assumptions behind the model, and I'm ripping a page out of economist Harvey Campbell's book. He's an economist from the Duke School of Business. And essentially what the assumptions behind the model are is that investors hold a well-diversified portfolio, which is essentially captured in the fact that the capital asset pricing model has an expected rate of return of the overall market. So that component captures that assumption. And the other assumption is that capital markets are perfect, meaning that they're perfectly integrated. So there's no transaction costs, no taxes, no policy, no friction with policy in terms of capital inflows and outflows. The third assumption is that the asset returns are multivariately normally distributed. So the asset returns follow a normal distribution, and this was actually an issue that he said is that a lot of emerging markets may not follow a lot of emerging markets returns, rather should I say, do not follow normal distribution. And this was a very this model actually won Lintner and Sharpe a Nobel Prize, but the fundamental issues with this model overall is that it assumes that the market is perfectly integrated. So is that actually true with emerging markets? That's a huge issue that was brought up by Campbell, as well as the fact that a lot of emerging markets returns are not normally distributed, and that issue was brought up by the fact that emerging markets returns are sensitive to sharp crises, such as the Mexican crisis of 1994, where the Mexican government basically issued debt that was to be paid back in US dollars. But there was a political crisis where there was an assassination of a presidential candidate, and that led to a peso drop in relation to the dollar. So that led to an economic crisis. And a similar situation happened with the Asian crisis of 1997, where the Thai baht collapsed, and that led to an economic slump in Southeast Asia and Asia as a whole. So emerging markets are very sensitive to those types of currency fluctuations. So given that those are potential issues that could influence the rate of return of emerging markets, what I sought to do was I wanted to test the notion that could the capital asset pricing model still hold up against, still predict the expected rate of return accurately given those issues. So what I sought to do with this test is I took a sample of 5 emerging markets countries, and I analyzed their return over the course of 6 years, from the 1st of January of 2013 to December 31st, 2018, as well as the return of various indices to determine if there was in fact a positive correlation between the covariance of the stock with that of the market return. But before going forward, we should define what is an emerging market. An emerging market economy is one in which the country is becoming a developed nation, and it's determined through many socio and economic factors. An emerging market economy is a nation's economy that's progressing towards becoming advanced. So, it's moving towards advancement, and there's increased liquidity in both the debt and equity capital markets. And there's also a stock exchange put in place, as well as a regulatory body to manage the movement of capital. And this definition was taken from Investopedia. So with that being said, according to Morgan Stanley's Capital International Emerging Market Index, there's currently 24 emerging markets countries, so that's where I'm going to be pulling out the countries I'm going to be selecting for the test. So in this test, I'll be using Brazil, India, China, Egypt, and the Philippines. And I'll explain the selection in a later slide. So I chose, so with that being said, after I chose these countries, I wanted to look at the different sector breakdown of the various indices in these countries, meaning the Bovespa, the Sensex for India, the Shanghai Composite Exchange, so on and so forth. And I wanted to select shares in such a way that it gave a very strong and accurate representation of the industrial diversity of each country. So there's going to be a varying number of shares per each country because each country has different industries and different different bread and butter, so to speak. So here's the list of shares, and here is the t-test that I'll be performing. Essentially, I'm testing a null hypothesis whether the Jensen's alpha, which is captured by the alpha variable, Jensen's alpha of asset I equals 0, which is the null hypothesis. And the alternate hypothesis is Jensen's alpha of asset I does not equal to 0. So what I'll be trying to do is I'm trying to reject this at the 5% significance level, so it will be a two-tailed t-test. So the p-value of the alpha estimate has to be less than 0.025 for the null hypothesis to be rejected. And I'll extract the data from investing.com in the form of Excel spreadsheets. I'll import it into R to do a time series test so I could find estimates for alpha and beta. And then once I have an estimate of both, I'm planning on graphing the alphas versus the betas, with the betas being the predictor variables, the alpha being the output variables, to determine if there's a positive correlation between the two, very similar to a cross-section test. And here's a snippet of code that I used in R. I couldn't actually pull up RStudio simply because the recording software doesn't allow me to shift between two windows. And for the first country is Brazil, and the index for Brazil is the Bovespa index. And as you can see, only 2 out of the 7 stocks were able to reject the null hypothesis, one in the consumer space and the other in the financial space. So what we can see here is that there's varying betas. There's betas from 0.53 all the way to 1.45. And the fact that only 2 shares were able to reject the null hypothesis shows that this sample held up pretty well as far as the CAPM asset pricing model is concerned, its ability to predict expected rate of returns. The R-square values are rather low though, ranging from 37% all the way up to 81% for ITUB4, the Itoa Bank Holding Company. So that could be indicative that even though there is a positive correlation between beta and the expected rate of return of asset I, there could be other variables that are pushing it in that direction, and the variance isn't only explained by the excess market rate of return. Okay, so after that, we have the data for China. And in China, there was a higher failure rate because, as I mentioned before, the Chinese government imposes harsher capital restrictions in terms of capital inflows and outflows. So here, 4 out of 9 stocks failed the null hypothesis, and they occurred in the manufacturing, utilities, technology, and financial spaces. And here, the R-squared values are extremely low, much lower than in Brazil, all of them being under 2%, which shows that other factors are clearly at work here, clearly not just the excess market return. And the third country in the sample size is India. So here it actually had a very high success rate with only 2 out of 11 countries able to reject the null hypothesis. This was in the cement and the pharmaceutical space. This was for the Noi the Tow Company and LUPN, which is a pharmaceutical company. And And as you can see, the R-square values are quite low, which indicates what I said, in the previous two examples, with there being other potential factors creating a positive correlation. And another country is Egypt, and the index for this country is the EGX 30. So here it's a much more top-heavy economy, meaning the commercial bank of Egypt comprises of 37% of the market capitalization of this index. So 3 out of 7 stocks rejected the null hypothesis, so most of them passed. This was in the petroleum space, the industrials, and the tourism arena. And the higher pass rate could be indicative of the monopolistic structure of the Egyptian economy and of the index, which, like I said, the commercial bank has 30%, 7% of the index market cap. And finally, the final country that I chose for my test was the Philippines, and pretty much all of the stocks in the sample failed to reject the null hypothesis with the objection of Alaya Real Estate. And with that being said, here is the graph of the betas versus the excess monthly returns. And as you can see, there is a positive correlation between beta and the excess monthly returns, which means that there's definitely credence to believe that the capital asset pricing models holds for emerging market economies, at least for this sample. And below is the statistics for the line of best fit. And I'd like to talk about the complications that arose when trying to formulate this study and run the regression. Is that in the original capital asset pricing model, the risk-free rate was proxied by the 10-year U.S. government bond, the yield on the 10-year U.S. government bond. And the U.S. government bond had a very high credit rating, but other countries are not going to have this high of a credit rating. So essentially what I did was I took a country default spread, which was taken from Professor Damodaran from NYU Stern, for each country in the sample, and I added it to the country's current 10-year yield, or the 10-year yield over the 6th period. And this adjusted to create a true risk-free rate. And the second issue I ran into was determining which countries to actually select for the sample. So for this, I consulted the McKinsey Asia Capital Markets Development Index, which looked at factors such as investment opportunities, government regulations, transaction costs, transparency, and capital inflow and outflow restrictions to measure the degree of markets integration. I chose countries that had lower levels of market integration, like the Philippines, India, and China, in ascending order. And then I chose countries that had higher levels of market integration, like Egypt and Brazil, based on other literature, which is stated here. And I also chose mid to large size companies because they had a larger trading volume and they were more liquid. And the final conclusion is that only 12 out of 42 shares rejected the null hypothesis, which suggested that CAPM can still have validity in context of emerging markets. However, because the R-squared statistic was low for almost all the stocks, this means that the excess market return cannot be the only factor that's influencing share returns. So there could be other factors at play because, like I said before, the capital asset pricing model is just a one-factor model. So, to draw more insight into that, you could see that the financial and the industrial markets were the ones that were more likely to experience low p-value simply because they were more susceptible to volatility from more factors like commodity prices and government regulations. So it's there's other factors moving the positive correlation other than just simply the excess market return. And this is just a bibliography slide, and that's my final project and my presentation. Thank you.